Withholding Tax Management, an in-depth insight. Withholding tax, WHT, is a critical aspect of tax compliance for businesses operating in Kenya. It involves the deduction of tax at the source of certain payments, which is then remitted to the Kenya Revenue Authority, KRA. Managing withholding tax effectively is essential for businesses to avoid penalties, maintain good standing with tax authorities, and ensure smooth financial operations. Here are some key components of withholding tax management. 1. Understanding applicable transaction scope of WAP. Withholding tax applies to a variety of payments, including 1. Professional fees. 2. Consultancy services. 3. Rent for non-resident landlords. 4. Interest on loans. 5. Dividends. 6. Royalties. 7. Management and training fees. Legal framework. Businesses must stay informed about the tax laws and regulations that govern withholding tax, as outlined in the Income Tax Act, ITA, and any updates provided by the KRA. 2. Accurate calculation rate determination. The rates for withholding tax vary depending on the nature of the transaction and the residency status of the payee. For instance, professional fees to resident individuals may attract a different rate compared to non-residents. Dividends may have a separate withholding tax rate depending on whether the recipient is a resident or non-resident. Taxable amount. Accurate calculation involves determining the taxable amount from the gross payment before any deductions. This requires a deep understanding of what constitutes the taxable base for different types of payments. 3. Timely deduction. Point of deduction. Withholding tax must be deducted at the time the payment is made or when the payment is due, whichever comes first. Businesses need robust processes to ensure that the deduction is made at the correct point in the transaction. Consistency. Companies must ensure consistent application of withholding tax across all relevant transactions. This consistency helps in maintaining compliance and avoids disputes with the tax authorities. 4. Remittance to KRA. Timely remittance. After deducting the withholding tax, businesses are required to remit the amounts to the KRA within the stipulated deadlines, usually by the 20th day of the month following the month in which the deduction was made. Late remittance can attract significant penalties and interest. Documentation and filing. Businesses must file the withholding tax returns using the KRA's iTax system. Proper documentation, including withholding tax certificates, must be maintained to support the deductions and remittances made. 5. Compliance and reporting. Record keeping. Maintaining accurate records of all transactions subject to withholding tax is crucial. These records should include invoices, contracts, payment vouchers, and withholding tax certificates. Reporting obligations. Companies must report withholding tax transactions in their financial statements and ensure that they align with the amounts remitted to the KRA. This transparency is key to avoiding audits and penalties. 6. Challenges in withholding tax management. Complexity of multiple transactions. Companies often deal with a wide range of transactions subject to withholding tax, making the management process complex. Each transaction type may have different rates and regulations, requiring meticulous attention to detail. Changes in tax legislation. Tax laws are subject to change, and staying updated with the latest regulations is crucial. Failure to adapt to new laws can result in non-compliance. Cross-border transactions. For companies engaged in international trade, managing withholding tax on cross-border transactions adds another layer of complexity, as they must consider both local laws and international tax treaties. 7. Best practices for effective withholding tax management. Automation of processes. Utilizing accounting software that integrates with the KRA's iTax system can help automate the calculation, deduction, and remittance of withholding tax, reducing errors and ensuring compliance. Regular audits. Conducting regular internal audits of withholding tax transactions can help identify and correct any discrepancies before they lead to penalties. Staff training. Ensuring that the finance and accounting teams are well trained in the latest tax laws and withholding tax procedures is vital for maintaining compliance. Engaging tax professionals. Given the complexities involved, many companies benefit from engaging tax professionals or consultants who specialize in withholding tax management. These experts can provide guidance, ensure compliance, and represent the company in case of disputes with the KRA. 8. Implications of non-compliance: penalties and interest. Non-compliance with withholding tax obligations can lead to severe penalties, including fines and interest on late payments. This can significantly impact a company's financial health. Reputational risk. Failure to comply with withholding tax regulations can damage a company's reputation, both with the tax authorities and in the broader business community. Audit risk. Non-compliance increases the likelihood of being audited by the KRA, which can be time-consuming and costly. Conclusion: withholding tax management is a critical aspect of financial management for businesses in Kenya. By understanding the regulations, accurately calculating, timely remitting, and maintaining thorough records, companies can avoid the pitfalls of non-compliance and maintain smooth operations. Engaging in best practices and seeking expert advice, when necessary, can further enhance a company's ability to manage withholding tax effectively.